$285 billion, gone in 48 hours, because one AI company shipped a handful of free plugins. Welcome back to the comment section with Thomas Paul. Today we're talking about how a couple of Anthropic's Claude Cowork tools just triggered a $285 billion freakout on Wall Street, and why the real bill is going to be paid by workers, not the people who caused it. Here's the setup in plain English. On January 12th, Anthropic launches Claude Cowork. Think of it as an AI coworker that doesn't ask for weekends. Then on January 30th, they drop 11 open plugins, not just write my email stuff. We're talking legal tools that can read contracts, NDAs, compliance workflows, plus data and workflow tools that can start acting like mini employees. Here's where things get interesting. Within days, investors look at those plugins and suddenly remember what AI actually stands for: automation of income. Legal and data-heavy software stocks get smashed. Roughly $285 billion in market value vanishes. Goldman's software basket, down about 6% in a day. Thomson Reuters, the company behind Westlaw, down around 16 to 18%. RELX, huge in legal and data, off roughly 14%. LegalZoom, nearly minus 20. This wasn't some random bad earnings season. This was Wall Street waking up and going, wait, why are we paying recurring fees for SaaS if AI agents can just rebuild this workflow inside the company for pennies? But it's even getting worse, because this isn't just about some overvalued software names finally coming back to earth. This is about capital finally believing that AI doesn't just help white-collar workers. It replaces billable hours. It eats the whole task. And here's where things take a step further. People started calling it the SaaSpocalypse. Strategists at big banks warned that what looked like a correction could actually be the early innings of a long beating for software and data firms whose main product is structured knowledge work. Some baskets of at-risk European stocks tied to finance, insurance, legal, and property services dropped about 7%. Cloud and software ETFs are down roughly 15 to 20% this year, much worse than the big AI platform giants. One strategist at a major investment advisory basically said the quiet part out loud: if AI agents are good enough, why would a firm keep paying for bloated software when they can stitch together internal tools with an AI model and a couple of devs? But then, the unbelievable thing happened. The market suddenly did something workers have been told not to do for years. It took AI displacement seriously. For a decade, workers heard, AI will just make you more productive. It won't replace you. Now, the second AI looks capable of cutting software costs and labor at the same time, investors price in mass disruption overnight. Funny how the panic only arrives when shareholders might lose money. Let's zoom in on who's actually in the blast radius. If AI agents can review contracts, summarize NDAs, flag compliance issues, and generate legal memos, that puts junior lawyers, paralegals, and compliance staff directly on the chopping block. AI tools are already handling due diligence checklists, customer service routing, and basic wealth advisory-style Q&A. Here's where things get interesting. Think of an insurance back office. Endless forms, risk assessments, claim reviews. AI is starting to do first-pass evaluations. Same with tax prep. Upload documents, ask questions, get a draft return. The line between tool and replacement gets blurry fast. On Wall Street, that shows up as a red candle on a chart. Prices fall, maybe bounce back. Executives cash out stock over long periods. They're diversified. They land on another board if things go south. Workers don't get that luxury. They get hiring freezes, reduced hours, layoffs disguised as strategic realignment, and a LinkedIn post about exciting new opportunities that somehow forgets to mention rent. But it's even getting worse. The policy side is nowhere near ready for this. Right now, US and EU AI talks are mostly about safety, copyright, deepfakes, who owns the training data, and how not to blow up democracy with bots. All important. But when it comes to labor, protections are vague. Training, reskilling, job transition. Great buzzwords, zero hard guarantees. Republicans mostly talk about keeping America ahead and frame almost any guardrails as anti-innovation. Democrats talk more about worker protections, but when you look at actual law, you don't see sectoral bargaining, automatic wage insurance, or serious moves toward shorter work weeks baked into AI policy. And here's where things take a step further. Regulators also let the foundation model companies move right up the stack. Instead of just selling the engine, they're now building the whole car. Claude Cowork isn't just a model, it's Anthropic stepping directly into legal and workflow software. That puts them in direct competition with a lot of their own enterprise customers. And somehow this massive conflict of interest slid through with barely any antitrust debate. On X, the reaction has been exactly what you'd expect from this timeline. VCs and AI bros are out there posting software is dead, agents win, like they just discovered gravity. Finance guys are joking about shorting white-collar workers instead of coal miners, because nothing says serious analysis like turning structural job loss into a meme. But then he said this unbelievable thing labor advocates and tech workers pushed back, pointing out that a few AI majors can now destabilize entire career ladders in weeks. You train for years in law, accounting, finance, and suddenly the partner meeting is about how many junior roles can be augmented this quarter. Some experts on X did say markets are probably overshooting, that these software names won't go to zero, and that we've seen tech panics before. But even they admit volatility is a shareholder headache. The adjustment costs, moving cities, retraining, losing health insurance, that's all on workers. So who actually wins in this new AI agent world? First group, the model providers like Anthropic and its big friends in big tech. If agents do more and more of the work, the value shifts from the app to the underlying model and the giant cloud platforms running them. Also winning, a small set of AI-native startups in insurance, investing, and tax prep built from day one around agents instead of armies of junior staff. Here's where things get interesting, losers. Mid-tier SaaS vendors that can't cut prices enough to beat in-house AI tooling. IT outsourcing firms that rely on cheap labor to do repeatable tasks. Their whole pitch is, we'll do it for less. AI's pitch is, we'll do it for almost nothing. And then there's the human side of the loser list. Workers whose bargaining power shrinks as it becomes much easier to automate or offshore what they do. During the sell-off, we saw names across finance and software, Blue Owl, Ares, KKR, Salesforce, and big IT exporters, taking 6 to 13% hits in a day on AI anxiety alone. That's how quickly this narrative is getting priced in. But it's even getting worse because if we don't change the rules, AI agents just become the next excuse for another massive upward wealth transfer. So what do you actually do with this information if you're not a hedge fund? First, don't panic trade your entire portfolio because a couple of banks yelled AI. I watched my parents lose a big chunk of their savings when I was about 12 because a bank advisor told them a story that sounded smart. Headlines move faster than reality. Jobs and portfolios both get wrecked when you overreact to the story instead of the data. And here's where things take a step further. If you own defensive white-collar stocks, legal software, tax prep, back-office software, actually look under the hood. Ask, does this company have a real moat in an AI agent's world? Or are they just a fancy interface over tasks Claude can already do? For most people, diversification still matters more than picking the perfect AI winner. Be skeptical of anything sold as AI-proof. And if you invest through index funds, pay attention to the balance. You're probably holding both the AI winners and the SaaS losers in the same basket. Politically, this is where it gets real. If we want AI to help people instead of just shareholders, we need boring, concrete policies, stronger unemployment and wage insurance, serious public retraining that isn't just a Coursera coupon, and actual union power in tech, finance, and professional services. Here's where things get interesting. We should be pushing for a deal where productivity gains from AI fund shorter work weeks, universal basic services, or at least a baseline that doesn't involve people getting tossed out of the middle class every time a new model drops. Quick note before we wrap up, this video was created with Fludge.io, the same system that powers this entire channel. If you're watching this thinking, I'd love to run a YouTube channel like this, but I don't want to be on camera. That's literally what it's built for. Fludge researches, writes, and posts YouTube videos for you with an AI avatar, but you stay in control and can jump in at any step. If that sounds interesting, check out fludge.io. This is the comment section, so I want your take. Do you think this SaaSpocalypse is overblown market drama or the first real AI-driven crack in the white-collar job ladder? And more importantly, what kind of policies would make you feel safe using AI at work instead of feeling like you're training your replacement? Drop your thoughts in the comments, hit like if this helped you make sense of the chaos, and subscribe for more skeptical AI-soaked market breakdowns. And quick disclaimer, nothing here is financial advice. It's information and opinion. Do your own research, talk to a professional, and don't let an AI, including this one, manage your money for you.